let's get this set up properly. That'll do it, I think. All right, while we're waiting, hello, good evening. I pretty much have an idea of what we're talking about tonight. I don't know how much crowd input I'm going to take, but let's take a little bit. I'm just curious to see what everyone's interested in talking about. If you want to type in the chat. Yes, quite a day is for sure. Was there a way to predict this type of fall today? There were some stuff that I was watching that had me a little on edge all day, actually, from even before the market opened, but we'll talk about that throughout the broadcast. Okay, keep it coming. I'm just writing down what people want to cover. Some stuff that I might, if I don't get to it, I'll try and do it in the weekend review. Yes, oil was a very important factor today. A couple of more things at the 2-minute mark, which I'm watching closely, will start. Tesla, yep. That was quite a trade this week. I've been very happy with it, quite pleased. All right, so since there's not all that much people seem to want to discuss, I'm going to take the reins here. So all bets are off, and let's get cooking. All right, so we all know what went on today. There was a early market rally and a afternoon sell-off. So what caused this? Well, first and foremost, the rally was caused by a few conditions. One was that you had 2 days back-to-back with poor highs. Today actually had a poor high as well, and part of the pullback was caused by a liquidation break, but we'll get to that in a minute. Let's not get ahead of ourselves. And you had some growth-positive economic data this morning with the ADP jobs number. So that's the reason that the market rallied. When I woke up this morning, first and foremost, what caught my eye a little bit was Apple being down. And that, from the very get-go, had me a little bit suspicious of the type of day we were going to be in. They were down on two things. One was the Digitimes story about the iPhone being delayed. This is always market maker shenanigans. It never turns out to be real, but it always seems to fool the market nonetheless. And I guess it'll keep fooling them until it stops fooling them, if that makes sense. And also Spotify doing a deal with some artists. So that didn't hold Apple down very long. It wound up filling the gap and then even going higher. I actually used the 145 plus move this morning to take off my play for a couple of reasons. One is that the high open interest sort of started to peter out at 145, which told me that there were kind of a lot of calls to sweep, and there was a lot of puts that seemed to be put on. This week to me, I thought anything sustainable over 145, maybe 146 to me was going to be a tough sledding. And I'll tell you, I had a couple of moments today during the day where I almost put the Apple trade back on. I actually had some orders in. I had a risk reversal call spread, meaning I owned a call spread and was short puts to fund it. And I've been kind of waiting for an up move to take it off, and I shouldn't say I was hoping, but I thought today was going to be up big early. And I was disappointed that Apple wasn't up big with it, and that to me was sort of the tell to get at Apple. But as the day progressed, Apple was just getting stronger and stronger, and I was saying to myself, if this thing closed strong, I'd probably put the trade on back toward the end of the day. However, like what happens in a move like today when you see a bit of a cascade move, I pulled my bid, and bid pulling is what really causes a lot of that cascade movement. It's thin and stretched out, and it's not really big money selling. It's just sort of the lack of buying and stop running, and algorithms pushing on the move. You had 1, 2, 3, 4, 5 back-to-back minus well over 1,000 ticks, the lowest being minus 1393. That is a heck of a lot of selling. It's technically speaking what caused the pullback. So let's just dive right into that. One was the touching of the kind of the 2 times bottom up here on the that was prior support. It was 23.73 half, and the intraday Fed breakout was 23.74 half, and we looked 2 ticks above, came back down, touched the backside of the kind of the uptrend we were in, breached it actually, got a little bit below the Fed day low, which was 23.65.75, and then went back up and stalled again there. So you had a double top, poor highs, and then you had Fed minutes. So when the Fed minutes came out, there was a lot of hoopla about them on the media, and they were being portrayed as quite hawkish. I have a little bit of a different take on that, and I'm going to get to that in a minute. I have 2 pages here worth of notes. This was the one that I took from what they were saying on TV, and then this was why I was late to the broadcast, because I actually read the Fed minutes for myself, and I took some of my own notes, and I think there's some tidbits in there that I think will bring order to chaos here. Anyhow, so let's go through technically what happened. Again, maybe I'll again show this in the weekend review a little bit more, but I think really what took us down was a confluence of events today, late in the day, happening once. One was obviously the Fed minutes being construed as hawkish. The algorithms picked up on that. The day traders, who have been wanting to be bearish for days and days now, who got their necks wrung this morning like chickens, I guess put their positions back on, and they wanted to go out short today. I'm curious to see how great their trade location was, and I would caution people who were short down into the lows today, kind of on the break of the lows, because we did close quite a way underwater away from value, about 16 or so points, and currently about 17 or so points away from the volume-weighted average price. And I don't know what the developed point of control is. I'd have to take a look, but I believe it was up higher. It was probably up into like the 2370 area, 2371, just by kind of eyeballing it. I have to go back in and take a look. So that's what caused the liquidation break, and I think once the algorithms and traders were able to get it through the VWAP, you had that kind of cascade effect, because when in doubt, right, palms out. No one knew what was kind of going on, and you also had Speaker Ryan news breaking on the tape saying that he thinks tax reform is going to take longer than expected. So this was sort of a witch's brew for a move lower. Anyway, let's get into the Fed. I don't think I'm going to even bother with the notes taken from the TV, because it's kind of useless information compared to my better reading of the Fed. So let me just go in, and I kind of didn't get to even finish the very end of it, because I was getting delayed into when I was starting as it was, but I got the meat of it. So they talk there about being some uncertainty about policy. They talk about a little bit of progress on the inflation mandate, which again is a little bit hawkish. This is really, I think, what spooked the market, because I don't think that they came to a decision about how they're going to handle their reinvestment policy, but they said that there might be some type of an adjustment to that into later this year, 2017, or early 2018, And they talked that the market expected phasing out as its expectations. They didn't know whether they were going to do it being based on date dependent or economic dependency, meaning were they going to set like every meeting, we're going to do this, or every meeting we're going to do that, or is it going to be based on the data? And then there was a debate, even if they were going to phase out or do it all at once. They were saying they kept on stressing again and again, though, that they want to be gradual, predictable, and kind of passive. They don't want to impact onto the market. The whole point of Fed policy and QE has been to reduce volatility in the market, and they're worried that their policy would create increased volatility. So they say that the phase out would reduce volatility, but if they did it all at once, it might be easier to communicate to the market, meaning the Fed is still doing what I have affectionately referred to as QE light, meaning that they're reinvesting like the runoff, the bonds that expire that they have bought. They take that principal and then they go out and they buy new ones. They do the reinvestment. So the fear in the market is that they're going to stop it all at once, and that kind of becomes a de facto rate hike. But then you have to start asking yourself, are they going to continue raising rates on top of that? That to me seems highly unlikely. Of course, in an algorithmic panic-driven market, when people are selling first and asking questions later, that logic doesn't necessarily come into play. But it seems to me that if I were on the Fed, let me before I say what I would do and what I think they're going to do, let's get to that. Then like I said, they talked about it being easier if they do it all at once, and I think that's what freaked out the market. And then some members wanted to tie it to economic conditions, and then some wanted to tie it to the Fed funds rate, meaning where the rate is would determine how much reinvestment or non-reinvestment they do. Anybody who suggested that, this is where I want to step into my role here as somebody who has street smarts and book smarts. I've studied Federal Reserve and their policy quite a bit in college and over the years of trading, like 20 plus years in trading. Whoever suggested that, who wants to tie the amount of Fed reinvestment to the Fed funds rate, is an academic wonk and clearly doesn't understand how Wall Street works. I will tell you this as a trader, and this is exactly what will happen if they do this. I don't believe this will happen because to me, they want to talk about ease of communications. This will not be easy to communicate. But if they were to do that, what they are basically doing is opening up the door for short sellers to ram that rate to exactly that point and to create a very easy market flush. And they don't understand how financial markets work. What's going to happen if they did that, they tied it to where the rate is, the market's going to take it right to that rate, and then they're going to test the Fed. So if you're listening out there, Yellen and co., don't do that. What they should do, if they want to be gradual and predictable with reducing the balance sheet, by the way, they said they're going to be very clear in communicating this ahead of time, so they're not just going to spring it on us. What they should do is go with the gradual and predictable. And what I would do if I were them would say that they either should do a date dependent, meaning, we all know when they do rate hikes now, it's going to be in a press conference meeting, so that would be the time to do it if they wanted to do it. Or they should do it with some type of economic standard. I don't know what that would be, but I think that they'd be better off doing the gradual and predictable, like staying with the gradual, the phase out, rather than doing it all at once, even though it's easier apparently for them to communicate. I don't know why it would be so hard to communicate saying every fourth meeting we're going to reduce our policy. I mean, it's not rocket science here. One thing I don't understand, and again now stepping into kind of my my explanation hat here, is the Fed is living in a dreamland. There is very little economic growth here. We're splitting hairs here between a 2% and a 1.5% economy at the moment. And they've talked openly before about running a hot economy. if this is their version of a hot economy, I don't know what, I mean, it's almost like Stockholm Syndrome. They've fallen in love with their captors of slower growth. Anyway, moving right along. They talked about, again, they stressed passive and predictable. So that to me, again, if they want to be passive and they want to be predictable, it's going to be the more gradual expectations. I really, really doubt that they're going to just cut the reinvestment all at once. I don't even think they should be cutting the reinvestment at all here until we start actually implementing some of the fiscal policy, which was another freak out, by the way, of the Fed here by saying that they don't expect anything to happen until 2018. Again, that was reinforced by Speaker Ryan, and that is why we went into a nosedive, because the rally of the market, a lot of it is predicated on corporate tax reform, repatriation, deregulation, so on and so forth, and any delay in that could cause trouble for the expectations of growth. They talked about the labor market improving in January and February, although they talk out of the both ends of their mouth with raising GDP, slowing GDP. I don't even think they know at this point. Their forecasts for growth have been wrong for so long. I mean, it's almost laughable that they even still make them. They talk about mining and manufacturing improving. They talk about automotive being flat, but did note that it has been slowing lately. I'm curious to see how that's going to factor in into later minutes. I think that's going to start becoming more important. They talked about personal expenditures slowing, but they attribute that to residual seasonality, whatever that means, and say it 10 times fast. They talk about the trade deficit widening. Again, if you start hiking rates and tightening policy, it's going to get even worse. That's going to strengthen the dollar. They did talk about inflation expectations being balanced, but it has been ticking up a little bit. They said that the GDP was lower, again, a little lower than expected, and again, they threw in this fancy residual seasonality, meaning that, I guess that's their new version of transitory for the weather. They talk. Oh, then this was another beauty. This was a little gem. They talk about the market. They said it being historically expensive here. I think what people don't understand about the market is that the market vacillates between PE multiples. When we're in a crash, it gets to about 10. Anything below 10 becomes unsustainable. And then when you're in a kind of a bull market rally, it floats up to about 20, and then above there becomes unsustainable. And there seems to be this like long-standing misnomer, in my view, that the average multiple that stocks should trade at is 15. Just because I guess you take 10 and 20 and divide it in half and you get 15. Completely moronic, but this is what goes on. This is what you get when you listen to TV reporters. And I'll just, so the market has been around 17 lately. So it is historically expensive. But what the Fed leaves out is it's historically expensive because of the Fed. It deserves to trade at a PE multiple premium. I've often talked about the DCF valuation, which is discounting future cash flows, which is of course how you value stocks. I don't want to get into the dividend model and all that stuff, but let's just talk DCF, because that's what you'll get if you pull up this on a Bloomberg terminal. When you discount cash flows, there is a risk-free rate that is used. And when I was in college, when I was studying, we were taught to use 5% as the discount rate, the risk-free rate. The Fed has now taken that 5% and brought it down to 3 or 3.5%. So that is why stocks are trading at a PE multiple premium, because the hurdle rate, the discount rate, has been lowered substantially. They keep talking about normalizing at a lower than normal rate, and that is the reason why the stock market is trading at a premium. It deserves to trade at a premium with a lower than normal discounted rate, a further out rate. Now, this becomes a circular reference at some point, because if you pull up TLT wound up closing like sort of on the highs of the day. Now, people usually get worried, right? There's this reference here with bonds rallying being bad for stocks because it is a sign of of a recession. I don't necessarily agree with that, because in the great bond market rally, that's when the stocks perform the best, when interest rates go low. For some reason, and again, this is Finance 101, when interest rates go lower, stock prices go higher. Interest rates went lower today, but again, on the snap, in this crazy, bizarro world we live in, stocks went lower. So I'll say this: if I would be more worried about a kind of a crash, a really sustainable crash, if interest rates were really, really taking off, meaning bond prices were dumping. That to me is a bigger risk than if we get a bond rally. This again, of course, is great for stocks like the FANG names, just so you know. So what's my take on this? I think the market got a little bit spooked today. I think the market was looking for an excuse to get spooked. It got stuck at a technical level, and it had a bit of a washout on people kind of worrying about the Fed. Let's look at the macro picture. Are things improving or getting worse, meaning in the economy? My answer to that is that growth is accelerating. So that doesn't mean recession, that means means prosperity. Things are getting better. That could, of course, change, and we're going to get a big jobs number on Friday, but the ADP number has been good, and you've had now 6, I believe, in a row, Philly Feds that have beaten pretty handily. So growth is accelerating. That is a good thing. So anyone who's talking about this being like 2008 all over again is mistaken, or very early at this point, because we have not seen growth decelerate, and that's what you need to see. You also need to start seeing, for the bear scenario, you would need to see HYG start plummeting. And when I talk about plummeting, I mean getting below the 200-day moving average, sustaining that, and becoming in a trend, a downtrend. Very far from that. We've had some stutter steps here. It's held the 200. I don't even want to start entertaining that conversation until we start breaking the 200-day. I'm sure we will at some point, and everyone will want to start talking about it. But you have to sort of have it in a trend. And I guarantee you, yeah, I do read the chat. Someone just asked. I do read it. Doesn't mean I always address it. Anyway. That's my take. We're not in a credit crisis here, and we're not in a deflationary spiral. Although I will say this, if the Fed starts getting hawkish, most of what they talked about here is deflationary. So they better just cool their jets, in my view. I think that they would do themselves a great service by stepping back. I want to just mind you that these were the Fed minutes to the press conference Janet Yellen gave a few weeks ago, which was a super dovish press conference. So all of this kind of behind the scenes sausage making led to a dovish Fed decision and Fed statement. So I'm not making that much here of these Fed minutes. I think that they were way blown out of proportion today by a media who doesn't understand what the F they're talking about and want to create this panic situation. And it's interesting. I was having this conversation with actually somebody who is on air. I'm going to keep their name silent for the moment, but I said what interests me about the people on television is that they do their best to keep everyone afraid when the market is rallying and keep people out of stocks. And then when the market is tanking, they do their best to hold their hand and keep them in while the thing is tanking. I mean, it's complete insanity, but this is what goes on. Anyway, that's my take on the Fed. Let's get into some technicals that I see as being important. First and foremost was the basic double top today at the Fed intraday breakout point, where that was really where it was before it really took off on the Fed day. So it seemed to me like a logical area to maybe have a little bit of stutter steps at, and of course we did. If you go into the SPY, and I'm going to go through all the major market indices here quickly. I'm going to talk about some of these stocks, some of the ones you mentioned I was planning on mentioning anyway. So we've had a couple of days, like 327, for example, was a look below and fail below the 50 MA, and that resulted in a rally. We had a retest of the 50 on 430. I'm sorry, 4.3, and then anything above those highs to me was it was a good long test. So my target was really to be up to 138s. Today we got kind of close. The high was 237.39. Of course, now I'm talking about the SPY. So that's where it kind of stalled out. And then today we came back down basically into range. So technically, today was a bit of a look above and fail because you got above those highs, those recent highs, and then today came back in range. And we stopped, I think we actually had the risk today of being an outside day, although I don't really make much of it considering the range of the last couple of days has been narrow. So we've held now the 50 MA a couple of times. If we were to lose the 50 MA, I think at the very least we'd retest that recent low of 231.61, and then I do think at that point we might open the door to a 100 MA test, which is currently around 229. The breakout in the market from the consolidation range was really 228.34 to 229.71. That to me would be a logical area to retest. If we were to lose the 50 MA, I'd be very cautious, particularly the last hammer at 233.91. That would be, to me, the downside risk right now would be to the 100 MA. And then we'd reevaluate it. I think at the very least it would be a bounce point. So what I'm going to say is this. If you are short, obviously today's high of day to me would be a very clear point of a stop. I don't necessarily think that, like I said, shorting into the hole today was a great idea because the VWAP was like 2362, almost 2263. So we closed very far away from there. If there were to be a rally and you're looking to kind of try to lay them out, that to me would be an area of interest, like somewhere around the today's VWAP, volume weighted average price. I think we're going to get a better idea in the coming days if this today was sort of a one-day fluke. Like I said, was it just news-related? One day does not make a trend. But it's, to me, a little bit disturbing that, again, this is now multiple times we've tried to test above the 20 MA. This is now the the third time, and that has been the resistance. The 20 MA had been the support. Now it seems to be becoming resistance. So until you get above and close above the 20 MA, I am a little bit cautious on longs. If like tomorrow we were to go back up there, I wouldn't make very much of today. If the move is down and we do lose the 50 MA, be prepared that the 100 MA might be in play. There has been, and I keep getting this pointed out to me, I keep having people ask me, are you looking at IWM? I look at IWM. I look at everything. IWM, yes, has had a lot of relative weakness, and I had said today when, again, asked for the umpteenth time, that we were skating on thin ice at the 100 MA. It's in a bit of a downtrend. It's stalled. The rally, believe it or not, and I think I had pointed this out at the time, stalled at the backside of the old uptrend, and now we're kind of just bouncing around in range. 133s are really important in IWM. It seems like we may get a test there. If those are lost, then there's more things to discuss. Maybe 129s become in play again. There's a gap down at 130.90. I don't necessarily want to project that we're going to get that. We may hold range low. I always assume things hold until they don't, and then I take it from there. We've now had two look belows. We moved up to the top of range, and now I guess we're just coming back down to the lower end of range. So the 133s to me are going to be very important in IWM. The Qs. Now the Qs made an all-time high 2 days ago, and then again today. And today is looking like a look above and fail. We were above channel. This was now a look above channel and fail. It was an all-time high though, and we did hold the 10 and 20 MA. So I'll say this, is if it could hold the 10 and 20 MA, it's still okay. If it were to lose it, we may get a 50 MA test, which is the range low. When you look above a range and fail, you tend to rotate down to a range low. Currently, the range low is about the 50 MA. So if you're aggressive, and I know a lot of you are, you can use a break of today's low of day as a short entry with a stop about halfway or so through today's range, and you'd be targeting the 50 MA. That's sort of the current range low. So we had a look above and fail. We might be looking for a move down lower. With regard to Apple, so today should have been, in my view, a gap up in the stock, and when it wasn't, I told you how I traded it. I think I got out a little bit early on the play because it did go higher even after I took my play off, but by the end of the day I was so happy I did because, you know, I talked about taking it off at 145 plus, and the stock closed today at 144, a full over $1 where I made that call. I really was looking for 146s, but again, the way it opened today, I have a lot of experience with Apple. I have a lot of experience in the market, and I know when market makers are looking to play games, and this to me this morning was total gamesmanship. Usually what happens with that is it'll fill the gap and then it'll go down. So once we got the gap fill and a little bit actually above, I was out, and then it, to my surprise, or I should say lack of surprise, pulled back a little and then took off. And I started scratching my head. I'm like, wow, there's something really must be going on with Apple that nobody knows about. Maybe they have a new product coming out. And if Apple would have closed today near the highs, I would have put my play back on. So if you want to play with Apple, if you want to be long, I think you have to use a buy stop up over the 100 MA. I won't get too concerned about Apple, even if it does pull back, as long as it can kind of hold 142. Currently, the 20 MA is 141.52. The 20 MA has really been the big boy, important moving average for the stock. And if it were to lose that, I'd get a little bit worried. I do think that there is some pinning action in this and that this could be a little bit weak over the next couple of days. I don't really see today's high as sort of significant. The ideal scenario, in my view, would be for Apple to set up my favorite setup, everyone knows, is the shake and bake, right? I'd be very pleased with it to have a pullback ahead of the earnings. Just so you know, this Apple doesn't seasonally do well the next 2 quarters, and there's usually weakness in the stock, and then it kind of ramps into the into the fourth quarter. So I wouldn't mind a pullback, actually. Easy to say now, right, that I'm out of the stock. So yeah, that's my view on it. I do still think the stock has more to go, but I would think it has a bit of a pullback. Someone just asked me about the semiconductor index. The 50 MA has been the key level there. It is starting, if it were to take out the recent lows of that big kind of bar, the 137.96-ish area, 133.87 to 133.79, you'd now be kind of, it's been in this consolidation, it would start kind of looking like it might break down. I don't really want to make too much of that until it breaks the 50 MA. If it were to break the 50 MA, I think 100 MA is in play. And then, I'd probably be looking to cover and reverse for a long. NVIDIA, I'm actually kind of bearish on. I mentioned this in the last couple of weekend review videos. You have a double top. It's making the last swing was a lower high, and now you were right on the real key neckline of 99.38. Oddly enough, pinning this week might save this thing. It might want to pin 100, but I do think at some point this has a date with destiny down at the 200 MA. Now that the 100 MA today, it was lost yesterday, and today it's stalled at the 100 MA. So we could be looking at a move lower, right? This, to me, looks like a topping pattern in NVIDIA. I wouldn't really, honestly, I wouldn't be super bullish in this stock until the double tops up at 120.92 were taken out. And after that, I mean, there would be nothing to stop this thing from just going. So that's my take. But like, if you look at some of the other ones, AMD kind of looks like it's topping a little bit. Not the most pretty move. I had tried shorting that, and it wound up being a bit of a stop out, which I was not thrilled about. And look what it's doing. I mean, it hasn't been an easy trade. Intel is kind of like the really important one to watch. Also, look above and fail on the high on 127. We're now back getting closer to the range low. I'm just looking at this. You have a couple of topping tails. If you want to use today's stop, is important to me. But I mean, Intel is still above the 100 and the 50 MA. You'd really need to see this thing lose the 50 MA and that 100 MA confluence. Even then, you still have the 200 MA right below. I think that this is going to be a very frustrating trade to try to be short something like Intel. I think it's going to do like what AMD did and be play these games, at least until the earnings. Now I'm just going to go through some of the stocks. Oh, let me do a couple of other ones. I promised. My whole plan, by the way, for today kind of got upended by this kind of wild move by the market into the end of the day. That, of course, had to be covered. So I want to talk a little bit about what I wanted to talk about earlier. I had this whole great stuff with psychological things to talk about, but that'll have to wait at this point for another day. Let's talk about. Let me see. Was there anything in here I wanted to try to salvage? Actually, you know what? Some of this is pretty good. I think I am going to discuss it maybe toward the end. But let me talk about a couple of these stocks. Taser, for example, they're changing their name to Axon, AAXN tomorrow. They're changing their ticker. I have really mixed feelings about how the stock traded today and how it, excuse me, and the news they announced. First and foremost, it had a look below and fail below the neckline of 2139. That's also was a kind of a reference low. That area is very important. As long as that can hold, the stock kind of has some potential. If it loses it, I think it's going to go down to the 19s where I'd be a buyer. That would be channel low and a little bit just below the 61.8. I think that area would be good. So what did they announce today? They announced that they're changing their name and that they're now going to give away their cameras basically for free to any cop who wants one with a year's free of service. And then I guess after that, replacement cameras, which I would imagine there are quite many. They must break a lot when you're in the law enforcement industry. That, and then I guess the service, it's really a subscription model. So they're basically giving you the razor so you can continue to buy the razor blades. The problem for Taser lately has been margin compression with competition coming in and undercutting them on bids. So I think Taser was just like, yo, F this, let's just go in and wipe these guys out. So I think they did that effectively with what they did today. And I do think that they're going to pick up huge market share, and I think that's really what they're playing for. It's a longer run game. The problem I'm kind of debating in my head is how will analysts look at this? They're now not going to have that camera revenue, and the subscription revenue is now pushed into the future. That subscription revenue is going to be much bigger than it previously was because you're going to have all these people with cameras that they have to then pay for the recording and storage. But short term, the numbers may have to come down because they're not going to have that revenue and you're giving away free cameras with a year's worth of subscription. So I think Taser might be dead money for a little while with a risk to 19s. But in 19s, I'd be interested probably in selling out of the money puts. Snapchat is just a total piece of crap. They might as well snap, anyway, they could snap the nuts, right? Snap these nuts. They are awful with how the stock is trading. It lost 21.33, which was the last swing low. Very important for me. I had sold some puts pretty well down, actually near the dead lows. And today I stopped out of it for a small gain. I sort of should have, I was thinking about stopping out of it at the IPO price, which was 24. That was a bit of a mistake because that's really where I thought it would turn, and it did. Now we're coming back down. I guess we're going to retest that area. I'd probably get interested again either on a break of trend, and I'll show this in the weekend review. This was the last time it kind of took off, or closer down to those reference lows, particularly if it could make a higher low. It may make a lower low, we'll have to see, but it seems to me that it's in a downtrend. Anything below 21.33 to me is a little vulnerable. I would even maybe set the buy stop if I was interested above today's high of day, particularly like if it happened tomorrow, then today would have been a false move. But Snap is just a piece of junk. Sonic I got into the other day, actually on their earnings day, on the retest of the 50 MA. Oddly, it happened the same day. I had put that order in, and I was sort of like gulp when it filled the same day. I was like, oh boy, you know, like, and my idea was to stop below that earnings day low of day, which was 24.003. But I was like, all right, you know, whether it did it today or the next day, I'm still cool with the play. Today it was really a lot stronger, and I think got caught. Today it had the move. It kind of broke out of the consolidation range and still closed above range, which was good. It really needs to clear 26.72, which was that high of day, and the 200 MA. It stalled just short of the 200 and just shy of the 100 MA. But I think a lot of that weakness was caused because of the overall market. I guess you could use, if you're really quick, anything that sustains below 25 half-ish, that was the breakout, as a stop. I'm probably going to just keep mine at 24.73. It wasn't really a very big position for me, and I want to give it a little bit of a chance to work. But that's my view on Sonic. I really don't have much of an opinion about the company or the product, just the fact that it was a stock that reported earnings that weren't great, and it went up, and that to me is always interesting. Let's talk about the 800-pound gorilla in the room, and I'm sure everyone knows what we're about to talk about. Of course, it's Amazon. This thing is a monster. It stopped just shy of my upside target, which is the 1.618 fib extension, which is 931.94. We are way above the channel high, which is roughly around 892. This may have some pinning issues at like the 900 level going into the end of the week. That would not surprise me. So I think that I'm bullish on Amazon longer term, but we're getting really, really close to my target, my 1.618 Fibonacci extension target of 931.94. So I hate to say it, but Amazon is a sell on rallies. I would absolutely be thrilled to whatever to buy it on a pullback. And now that it's coming from an all-time high, you don't really have to worry about it being, you know, it's not in real super danger yet. First you have to pull back, rally to a lower high, and then it has the danger. So I'm definitely in buy the dips mode here, but I'll probably give it a couple of days to shake out. And if it ever does get to the 931.94, that is kind of my end target. So just be a little bit cautious with that one here. Let's flip back into macro mode for a moment with oil. So you had another bearish inventory number today, and we got my upside target here, which is 51.72. And we closed just below 51s. We basically looked above and failed at the 50 MA, and today closed below the 100 MA. If you want to be short oil, you could do it with a stop above today's high, I guess. Excuse me. The downside target to me would be 49.61. If that doesn't hold it, I'll start getting a little bit more iffy. But if it can get above and hold 51s, I think it will firm quite significantly. Longer term, I'm a little bit more bullish on oil because now we're going to start having this seasonal factors in our favor, meaning production is shutting down to retool to start doing the lighter crude that's more for summer driving season. And you also go into that summer driving season, which is good for gas. So I kind of am a little bit of an oil bull. Gold, I'll tell you this, gold had a bit of a double top and is just kind of hanging out underneath the downtrend line. If you can clear the 200 MA, this thing is going to rip. So I would put the buy stop above the 200 MA as a right or right out trade. So I have been bullish, very bullish in silver, as most people know. That is above the 200 MA and well above the downtrend. And if you could take out that recent high of 1753, I think this SOB has some legs to it. So I'm a buyer of dips. I think for sure in silver and gold, I want to be a buyer over the, I may actually even put this order in right now, a buy over that recent high of 120.40, and my projected move on that, I could give it to you actually. I'm going to just eyeball it. My projected, I think we'd go up to 124s. That's where I think it would go. That's the primary downtrend line. We have a secondary here. If we broke that, I think we'd go up to 124s. So that's my back of the hand envelope, whatever, calculation of that. A couple of things I wrote down that I want to go through quickly. I think that these things, if you listen to them, will help you greatly in your trading. I find that I do this as well, and I know a few of my followers do this, is that they watch too closely how the sausage is being made, and it prevents them from being able to kind of follow the main move. So just keep that in mind, that you don't have to watch every single tick. Kind of play in the direction of the main move. Keep in mind, like I did with Apple today, what should happen and what does happen. According to my dope, Apple should have gapped up today. It didn't. That to me was a problem. So that led me to book the play. When your thesis for a trade is invalidated, meaning the reason you got into it is no longer valid, just get out. Get the F out of the trade. Why? Because you're now allowing... This is an important distinction, and I highly suggest writing this down because it takes a little time to kind of absorb. Be in a position because of your bias. Don't allow your actual position to be your bias, meaning you're long Apple, so you're, of course, bullish on Apple because you're long it. Nuh-uh. Only be long Apple because you're bullish on it. The minute you're not bullish on it, get out. That's my, and I just picked on Apple because we've been talking about it, but that's for any stock. Always understand if your trade thesis is validated. Know the game that is being played by the market. Today, for example, was oil. At least early. It became the Fed, but that was a whole other story. Early on, the market was trading with oil. You had the initial gap up, but the intraday volatility was when the EIA number came out and oil dipped. That's when the S&P dipped, and when it started rallying again is when it started rallying. Know the game that's being played. This is also a big one that I use a lot, probably more than I should even admit to. I eyeball my P&L. Like, I roughly know what I should be making or losing every day based on where the market is. And before in the morning, when there's the morning gap, I take a look at what my P&L. I know in my mind where my P&L should be, and then I look at where it actually is, and if I'm doing better or worse than that. That lets me know if I'm on the right side of the trade. Very important. I've also mentioned on multiple occasions, you have multiple days up or multiple days down if you're short, and you're massively outperforming the market where it should be. Like, let's say the market's up, 100 points, but you're up as much as if it were up 300 points. One day, that's not a big deal. If it happens like 3, 4, 5 days in a row, just close your positions. I'll tell you from past experience of ignoring this, you'll be very, very sorry in short order if you don't, because it means that you're getting toward the end of the move, the wagons move fastest, they say. I forget where I heard that from, but it moves fastest. I think it's a Daltonism, that it happens closer to the bottom of the hill. So when things are moving really, really fast, like the end moves, like in stocks like Amazon, for example, when they're moving up 10, 15 points a day, that's more toward the end of the move than it is toward the beginning. The trend is your friend, and play in the direction of the main move. I have so many people I talk to who want to short stocks that are going up, that are in clear uptrends, because they think it's going to pull back like a couple of bucks. Don't bother with this nonsense. Wait for the dip and buy the stock. Go in the main direction of the trend. Don't try to fight it. The same thing with a stock that's downtrending. Stop trying to buy the dips. Short the rips onto the downtrend line. Go in the direction of the main trend. That, to me, is the better money. This was another one that's really important to me. When you need to ask others, you don't know, and get out. I'll tell you, 100 people could honestly tell me a position of mine is wrong, and if I know that I'm right, I'll stick with it. Honestly, I never care what anyone else has to say. It sounds quite arrogant, but experience has proven to me time and again is just to trust myself. And when I listen to others, that's usually when the problems start. And why do the problems start? It's because I don't know. And that I'm allowing myself to be influenced by another means I don't know, and I have no business being in that position. I'm only in positions when I know, if that makes sense. So if you don't know, get out. If you do know, stay in the position or add to it. Keep it simple, stupid. Anyway, those are some additions I think that may actually find their way into my Risk Management 2 video. If you haven't seen the first one, I highly suggest watching it. It's on my YouTube channel. But these are some kind of updates of things that I've noticed mentally that I think will make a big difference in performance. Anyhow, that's my story. I'm sticking to it. I've outlined my levels. I've outlined what's important. And let's see how the next couple of days go. If tomorrow and Friday are down, for example, we might get like that washout Monday or Tuesday and get our turnaround Tuesday. But let's not get ahead of ourselves. Let's see how we do tomorrow. Like I said, SPY needs to get in my eye on SPY. Little homage to my old friend Montana, that it needs to get over the 20 MA and hold. If not, it's still a little vulnerable. One last, someone asked about Tesla, really important. I've been a bulldog on Tesla. We got real close to my target. I said I thought we'd see 306.48. That was the 2 times range or whatever, the measured move, sorry, the measured move. The measured move doesn't have to be exact, but I knew that the old, I'll go into how I knew the old highs wouldn't resist in the weekend review video. This is, by the way, something you're not going to want to miss, and this is a big deal. If Tesla pulls back, as long as it holds 287.39, it's still kind of okay. I wouldn't even be surprised to see this thing come down a little bit further, like down to like fill up some of these gaps. But I do think that this is going to stay high for a while, at least until their earnings. If this pulls back ahead of the number, it's probably a buy for earnings. If it keeps rallying ahead of the number, there could be a little bit of sell the news. I'll get a little bit more detailed on that when I could show you my charts and trend lines and things like that. I would not be first chasing Tesla here. The upside, in my view, if it were to happen like tomorrow, is to the channel high at about 317. You'd be coming up from the channel low, and at that point, I would probably try a right or right out short. So we're getting close to target. Good idea to book some profits. And yeah, that's my view. I still think Tesla may have a little bit more upside to it, but we're getting risk-reward wise a little closer to my end targets. So have a great rest of our trading week. I will see you on Sunday. Follow me on Twitter, my stream at Justin Pulitzer, and I will update you with what I'm thinking with regard to the markets. Have a great rest of your week. If you haven't watched my risk management video, I highly suggest doing that, and cheers.